So let's open the meeting. Right, it's 9:30 and I declare the Audit, Risk and Finance Committee meeting ARF 23/3 open, and welcome all present staff and councillors, and including our councillors on Zoom, Councillor Sol, Councillor Thwaites and Councillor Henry, and I expect Councillor Sol will join us when he can. So there are no apologies, so we don't need to worry about those. Any declarations of interest that anybody needs to cover? No. Right. We have no public forum. So we will move into the presentation from Bancorp. Are they online? Coming in. And they'll be sharing their screen for us to see their presentation, but you have it on Stella as well. So just a reminder that this is live streamed. So supposedly they were.
Let's have to reintroduce them. Murray, they didn't hear that you were ready to go, so they've just joined after you spoke. Okay, to sort that out.
All right, so hopefully we have our presenters from Bancorp online, Suresh and Ross. So over to you.
Right. Hello, everyone.
Hi, good to see you.
Good. And I've got Ross with me. He's just come back from maternity leave, which is very timely, given I'm just slightly under the weather, but I will start the presentation, and if I fall over, Ross is right there to pick it up. Right, now if I may share my slide pack with everyone. Now, please let me know if everybody's got a good view there.
Yes, thank you. It's working well.
Great, thank you. Right. We'll try to keep the presentation short. I think it's not going to deviate too much from when Ross presented to you a few months ago in terms of the outlook for interest rates, inflation, except I think the point we will make through this is that, you know, we are starting to see the implications of these high interest rates, and the outlook is starting to weaken quite rapidly. And there's been a couple of new developments as well, especially from the international front. So inflation, you know, the biggest topic in town, it has turned and it is turning rapidly for some. And obviously most of these guys here on this chart here, US, Europe, UK, China, report their data on a monthly basis. New Zealand's on a quarterly basis, so we are lagging. We're up there at around 6%. But, you know, the trend is certainly in the right direction. Food prices continue to be one of the main headwinds for us. But I think the point we need to make note is what's happening around the rest of the world. So inflation is falling. One of the biggest concerns we now have and have had for a while is what's happening in China. And that's finally come to the fore, really. And it is our largest customer. So that's what worries us quite significantly. They are now in deflation. So last week, they printed a minus 0.3 year-on-year inflation figure. So they are in deflation, and they're a stark contrast to the rest of the nations that are shown on this chart. They have got challenges, domestic challenges, and we're starting to feel those come through in our export sector. And that's the bit now that's new to the equation, but it's going to put certainly downward pressure on our economy.
Rich, I've just thought I'd add, everyone probably saw the Fonterra announcement slashing their payout. That's pretty much the effect that Suresh is talking about there. Obviously, China isn't buying as much of our dairy products, therefore less money's flowing through to our export economy, and farmers are going to have less money in the tin. Therefore, they're going to spend less in the wider economy. So that's how China's slowdown is affecting us domestically.
And just on that point, Western or Bay of Plenty, full stop. The kiwi fruit situation is, well in the papers there. It's been a bit of a shocking year for them, although they've managed to scrape a profit on substantially reduced volumes and quality issues. And we're seeing that across numerous horticultural sectors, because, Ross and I advise quite a few people in that space. And, those headwinds are worrying us quite a bit, because that was one good positive about New Zealand is our export sector, and it's taking a big downturn. And that's one of the reasons the Kiwi dollar against the US is under pressure. And at the moment, we're under 60. Now, we don't have any currency charts to talk about here, but I just want to note that since the GFC, we've really only been under 63 times, and this is the fourth time. So, it's a strong signal that things aren't right. Just a bit of a focus here on our domestic inflation front, because I know that's going to be in the minds of most councillors and ratepayers is how difficult things are out there. This is the June data, because we lag a bit in terms of producing this. Food prices, the key headlines there, food prices up 12.3%. And in the period since then, there has still been upward pressure in food prices. And then, of course, housing and household utility costs up 6%. And in there, property rates related services, which covers the council, up 7.3%. Now, this covers everything to June 2023. It doesn't take into account the future rate rises that all councils are trying to or needing to push through this year and onwards. So, you could sort of take the view, yes, inflation is coming down, but there continues to be momentum in food and household related areas, including rates, that are putting still some upward pressure, or certainly not offering relief to the outlook for inflation. The other big contributor there, which won't dwell on too much, recreation and culture, sports equipment, etc., up 7.3%. But, hopefully everything's going the right way. We are now starting to see the impact of what higher interest rates are doing on households, and it's certainly dampening demand.
Yeah, sorry, Suresh, just to add, the one negative one you can see there is transport, and that's obviously fuel price related. But from 1 July, we saw the fuel tax go back to its full level, and we saw public transport rates, that subsidy come off, so those have doubled in price. And the other thing would be from 1 July would be all of the new increases in council rates that will flow through. So the September quarter data is going to be potentially uncomfortably high, but there will be other factors in there that will obviously, given the the slowing domestic economy, you'll see that come through in other areas of the CPI numbers. So that's probably what the RBNZ will be looking at. But there are a number of temporary things that happened on 1 July that will show up in the September quarter data.
Now, leading on from concerns around China, and also needs to be taken into context of what the outlook is for interest rates, is a very, very rapidly weakening export sector, which I've mentioned, and our commodity prices. So our commodity prices in US dollar terms, which is our major export currency, and in New Zealand dollar terms is dropping. We're back towards 3-year lows. We're not as low as what we were during the peak of COVID, but prices have dropped quite significantly. And as Ross said earlier, Fonterra slicing $1 out of the payout to a midpoint of around $7 is quite catastrophic for the dairy sector. And we continue to see this downward pressure playing out. Important to note too that this is happening while the Kiwi dollar is under 6 or heading under 60. So it tells you we're not getting much relief from a lower currency at this time. In terms of debt, this is the latest as of June 23, the latest update from the Reserve Bank around sector lending, which gives you an image of what's happening with households and businesses in the agri sector. Now, I always focus on the agri sector because it's always positive, because for about the last 5 or 6 years, they have been repaying debt. You know, we've hit peak dairy, etc., and debt has been diminishing. In fact, from 19 onwards, you know, it was below zero in terms of growth. But it's just ticked up in the last couple of months, and that is a sign that a lot of the agri sector is having to borrow just to cover costs at the moment. They're not certainly expanding, it's more covering costs, which is worrying. The red line is the business sector. As you saw, when COVID hit, it dropped out completely. It took a while for them to sort of work out what plans and what they wanted to do. They grew their debt, they started borrowing, and now they've turned as they head into an economy that's facing quite a number of headwinds. So the business sector's cutting debt. The interesting one there also is the housing sector, the blue line. You know, they thought it was Christmas post-COVID. They borrowed as much as they could, and now that's retreating at a rate of knots as well. As higher interest rates dampen the ability to borrow, certainly for housing, and probably, you know, flow on into the consumer side, buying cars, etc.
Suresh, can I ask a question on that one, please?
Please.
Going back to that previous graph, when you say it's dropping, that they are still year-on-year increases.
Yes.
The scale. So is there any absolute drops, or is it just a lesser increase?
It's a lesser increase because people are unable to borrow. And very good question. You'll notice, if you've got a business that makes money, you know, you make a lot of money, you have good years, you pay down debt. That's what those green lines represent. You know, agri went and paid down debt when they had money. So did businesses. You know, if businesses, you know, I can't think of a direct example, but if they've got good cash flows, they pay down debt. The housing sector has always been a different one because, you know, you borrow $1 million for a house, you can't pay that down in 3 years or 4 years. You know, it's a 30-year commitment, and therefore the blue line never ever really gets a negative, and that's always been quite difficult. But there has been a sharp decline in borrowing in the housing sector. It is still positive to an extent, but I just don't see, a lot of people are now failing to meet the requirements of bank lending because, you know, they don't have enough income to support higher interest rates or hurdle rates. because I think they're supposed to be testing people around 9.5%. And so we are seeing a decline, but it's pretty hard to repay a mortgage without, and the only way to do it is to sell the house.
And someone's got to buy it. And you can see
Gotta buy it.
that lending is now down to its lowest level in a decade. So Suresh is right, it never goes negative. The housing sector never net pays back debt, but it just will grow at a much, much lower rate.
Thank you. And another question from Councillor Crawford.
Yeah, hi. Hey, just on the housing one, in June, that had a big spike. What did that jump? That's quite a significant jump with business dipping. What was the effect cause of that?
Sorry, and which June 23?
June 21?
Yeah, June 21, sorry. Yeah.
Oh, sorry. That was
post-COVID, wasn't it?
That was 2% mortgage rates in a nutshell. And it's very interesting. You look, there was a big gap. It took businesses a while to sit back and go, right, what's going on here? What are we going to do? And then once, a business says, right, we're going to double the size of the factory, we're going to build this or build that, it takes a year or a bit. So it took them a while to get back into CapEx, so to speak. And that's that red line. But they're turning the tap off now again as well. But the housing market was instant, because you just turn up to the bank and then buy the house or go to the auction the following day. So it was.
And don't forget, there were pretty much no job losses through COVID. Most people, even if they do lose a job, they were well subsidised with the government. So pretty much every household had its income from before. It's just now, as Suresh rightly pointed out, mortgages went to 2%. So you could suddenly afford a much bigger mortgage.
Thank you. And one more question from Councillor Joyce.
Yeah, just looking at the business lending, how big a factor is the concessionary government loans that are being now hauled back by the banks quite aggressively? For example, if you look at that chart, obviously none of us felt like borrowing when COVID hit. I was personally walking around my warehouse wondering what I was going to do with all that stuff.
Yeah.
Then we had an extremely good year as the sugar hit from the government took effect. So that's the plunge in net borrowing because we didn't need to. And then we got the next hit was obviously the cheap IRD and commercial lender loans, which are now quite aggressively being required to be paid back because they're on concessionary terms. So, is that, to me, that graph sort of looks like it might represent the concessionary lending cycle a little bit on the red line.
Sorry. I think, all those things have been pulled back. I agree. But I think if we reflect on what we see across our business or corporate client base is uncertainty. If they're exporters, they're certainly pulling the pin on CapEx. So, the number of clients that I've got where debt levels are falling because of the uncertainty is the key, I think, here, as opposed to saying that, because they're having all this cheap funding pulled away, that's the drop. This is bank lending. So some of those things you're talking, I suppose it includes some of the bank lending where the RBNZ lent at the cash rate to the banks. That's in here as well. But I think trying to answer your question is corporates are worried about the outlook and they're dropping their borrowing.
Yeah. I think those ID loans would be switched to bank lending. So that's probably holding up bank lending a bit more than perhaps it would otherwise be without those loans.
All right, thank you. We'll let you carry on.
Okay. Whoops. Sorry, where we are. Go. Now I always put this in for interest. It scares a few people. In 2021, we were number 2 in the global property index, because I think we had 30 or 40%, whatever it was, pick a number. And we were number 2 in the world behind Turkey. Now, Turkey is still number 1 with 132% increase in house prices. although I think they have 50 or 60 or at one point 80% inflation. So they've turned into a bit of a basket case. So they're still number one. We were number two. Now we're number two at the bottom. So we're still concerned. Only South Korea has had bigger house price declines. Now we're concerned about the economic impacts of this. You know, everybody thought they were multi-millionaires at one point in the last 2 years. Now they're not. And so this just highlights the extremes of what we saw in our housing market, that record low interest rates did in 2021. And now interest rates back to, 15-year highs is doing the opposite. Pretty self-explanatory. Now, we've just put a suite of charts here from the Reserve Bank. Now, the reason we do this is because it sort of tries to portray their thinking and aligns with our logic about what we think is happening with interest rates and where we're going from here. So just looking at these, we've got some on the house price inflation, which we saw earlier from a global context. But on the top left there, you can see house prices declines are at the worst since the GFC in 2007. So they're certainly fallen. They seem to have stabilized. And, you can read numerous economic commentators or the Real Estate Institute or CoreLogic trying to talk the market up, saying, right, that was the bottom, you better get in now because the next move's up. But at the moment, they seem to be stabilized. We still think they're going to be capped by what's happening on the right there, which is the top right, which are mortgage interest rates. That, a mortgage rate of 6 or 7 or potentially 8% if you're floating, you need a fair amount of income to support a reasonably large mortgage. So we've seen the decline in house prices level out, but I think it's still a very big moot point where they go from here if interest rates continue to stay elevated. Now, the Reserve Bank's made it clear that it wants to stamp out inflation like every other central bank in the world. And they will probably keep interest rates higher for a bit longer. But, we are starting to feel the consequences of higher interest rates. And then there will come a point where the market will capitulate, and so will the Reserve Bank, and we'll have to cut. And I'll explain where I think that's going when we talk about the chart there on the bottom right. Now, just to the bottom left, there, it's kind of important for councils because, consents and residential investment's very important for its outlook and for its planning. Obviously, we've seen a decline in consents because it's very expensive to build a house and it's very uncertain whether you're going to be able to sell it. So there's a couple of forecasts there, and that's the best we can do from the Reserve Bank, the smartest guys in the room. And there's two projections there from the February MPS, which is the blue line, and the May MPS, which is the red line. We're due for an update this week, on tomorrow, actually. Well, they'll update this forecasts. But they see a decline in consents, and then obviously an easing back or return to some normality, which will align with what happens with interest rates, because that's sort of their outlook is, we're going to hold the cash rate up and through in 2024, and it's likely there'll be cuts after that. So we'll need interest rates to go lower to stimulate housing again. Now, to the right, I think this is the most important chart of the whole lot. And what it shows, and we've showed this to you in the past, is what neutral is for what the Reserve Bank thinks the neutral cash rate is. And at the moment, they estimate it to be between 2 and 3.75%. This chart was done in May, so it shows a cash rate at 4.50. We actually have a cash rate at 5.50, so we are well above neutral. And, that reflects pain, if anything. And, our view is at some point, interest rates have to come back into that range because we can't see how households are going to cope with these high interest rates indefinitely, because those pressures are starting to feed through. And now we've got a new risk, which is our declining export sector as China really gets the speed wobbles. Now, even in the last couple of weeks, we've just focused on exports to China, which we can see. You've seen a decline in Fonterra's payout. You've seen meat prices falling. You've seen fruit prices under pressure, logs in particular. But the new thing in China too, which we haven't talked about here, or have a chart on, is their housing market, with a number of big developers now looking like they could go bust, because they're not producing sales, and they've got a whole lot of projects going on in China, multi-story apartments, etc., that are starting to fall over. So we've got a number of risks weighing against us, that's going to prove to be quite difficult as we head into the end of 2023. Focusing back on our poor little consumer here in New Zealand, this sort of makes sense why consumer confidence levels are still plumbing record lows. The global one there, which is the purple one, seems to have had a little bit of a spike, and that's probably a little bit of optimism in Europe. They don't seem to have as high interest rates as us, but you look at the Australian one, they're near their record lows. The US has sort of ticked up a bit. We've hit the bottom. We've had a few little spikes up, but it's in very, very low territory, and the current reading still is below our GFC low. So consumers aren't happy.
Just have a question on that from Member Henderson.
Sure.
Hi, Suresh,
Hi.
and I was just interested, what's your view on the impact to the New Zealand economy from what we've seen as a record annual increase in net migration? I mean, I think the figure I saw yesterday was 86,000, which my memory serves me right, sort of an average good year for us over the last 20 years was about 25 to 30,000.
Yep.
And I mean, what's your view on how that's going to feed through to our economy?
Yep. Right. Now that's an interesting one, because everybody knows somebody that's leaving or going to Australia, and so you look at the data of that. A bulk of that migration has come from India, the Philippines, and China, and so we are getting in a lot of people. I think it's pent-up demand. Our borders have been shut for quite some time, and these people have finally got in. So we've seen a big surge. I'm still worried. I mean, we focus on that headline number, but I do worry about what's happening at a sector level. You just have to read the newspapers, and you saw the other week Queensland Police Force actively advertising in New Zealand. So you've got cops going, you've got doctors going, you've got nurses. We as a company, we hire analysts, we struggle, we keep them for 6 months and then they're off to Australia. It's that mix that worries me more, Stuart, that, yes, we got a whole lot of migrants coming in to fill a lot of these jobs that were, we were short of fruit pickers, we were short of hospitality staff. And now you're sort of going, well, okay, hospitality. Okay, how's that going to play out? Well, are people going to go out to restaurants every week? Maybe not. We need to understand what that mix of people are. What was I reading yesterday? A hospital down in the South Island that basically shut down because it didn't have enough doctors. So, I think we need to really take a step back and not look at the headline migration. And if it's just pure labour that we are importing, for our construction sector, housing, all the stuff that we've been short of people, if they start to turn off, what are those people going to do? I'm not 100% convinced, but it is a positive, but we need to see, where those benefits are going to come.
Yeah, it's interesting.
Sorry, I guess my question was more, Suresh, not so much about what our direction of travel was
Yeah.
going to be, but I mean, that's a fact. That's a fact of 86,000 net migrants that are here, are here now. I'm interested in what the impact of what they're, I mean, that's 86,000 new spenders.
Yep.
86,000 bringing capital into the country, to 86,000 needing a home. I mean, it's, I know the impact is always going to be delayed, but I'm just interested to know what that, because that's a real number. It's,
Yeah.
you know, it's you know, we wait a long time to get these numbers, but it's a real tangible number. So I'm just kind of interested to know how that will feed through to our economy.
Yeah, it's interesting. We saw this debate just before the last RBNZ interest rate hike, when ANZ were calling for 6%, the OCR to go to 6%, and they were basing that on this very strong migration number. It wasn't as high as we've seen it recently, but it was still a very big number a month or 2 months ago. And the bank themselves, ANZ, said that this is inflationary. The RBNZ is going to have to raise rates because all of these people are going to be spending money, and that's going to increase inflation. The RBNZ took the exact opposite view. Well, in fact, they sat on the fence with it, to be honest. They said, we don't know the exact outcome. It could be inflationary, it could be deflationary. All of these people coming in, they, as Suresh said, we don't know the sort of mix of people, the skill levels of people. So they're bringing in their labour, but if they're low skilled, they're going to help compete with local low skilled labour, which will drive down the cost, which will actually reduce the cost of reduce inflation, because suddenly, you know, there's a bigger supply of labour, of lower skilled labour. And at the same time, you know, if you've got you know, if they're large families living in, you know, 10 people in a sort of 2-bedroom house or something like that, we might be losing, as you know, Kiwis go over to Australia, 10 people in, you know, in 2 5-bedroom flats or something like that, but replacing them with 10 people coming in living in 1 2-bedroom flat, that sort of thing. So there's the demand for housing is probably less certain, because again, that's going to be tied to how much these people earn and the mix of skill levels and incomes and that sort of thing. And the other thing is, as you mentioned, is capital. But I'm not convinced that, you know, a lot of people are coming out of the Philippines or India or China with huge amounts of capital and competing with, you know, or buying the houses of doctors that have moved over to Australia. So again, you know, I'm probably sitting more with the RBNZ on it's a lot less certain, the inflationary impact. I think it's probably a deflationary thing, because we're going to see that big supply of labour. You know, we're losing net on net, we're losing skilled workers, i.e. doctors and nurses and that sort of thing. But we are gaining probably, you know, younger, less skilled migrants that will upskill as they come in. But while they're, you know, their first job is going to be probably lower paid than a doctor or nurse.
And I think the timing's really unfortunate, because, you know, through 21-22, where we couldn't get migrants, and the Reserve Bank was saying, well, the lack of migrants is actually inflationary because our demand went through the roof, and, you know, we're all out spending and whatever we were doing, which caused a shortage of people. And now we're getting an influx of migrants at a time when households are going to stop spending. And so, you know, it's a very unfortunate timing, I believe. And yeah, it's what those people are coming to do. If they're coming to join the construction sector, you know, at a time when I think projects potentially could get shelved or things in place are probably going to continue, that might help, but it's a bit unfortunate in terms of timing. When we really needed the migrants, when we were booming, we didn't have them, and now they're coming. Hopefully that answers questions, Stuart. Ross, I'll leave you just talk about these bond yields. I'm starting to.
Yeah, sure. So we've seen quite a strong rise in long-term bonds globally. I think rightly or wrongly, the US is essentially driving the situation, and that's the red line, I believe. There, I've just got something in the way. But so the red line's the US 10-year government bond yield, and that's climbed, you can see, off its lows to almost the highest level it's been since this chart, or for this chart. I think you have to go back to just after the GFC to find a higher level.
Yep.
Essentially what's happening is the US, even though they've had a lot of interest rate hikes, their data still is quite resilient, and the economy seems to have absorbed those higher rates so far. I think there is pain to come, but right now the market's taken an optimistic view that the US economy has weathered the storm. It's going to achieve a soft landing rather than the recession that we're seeing here. That's driven long-term bond yields in the US higher. There's also more government spending over there. They got a rating downgrade. Their treasury is going to be issuing a lot of new bonds to raise debt to fund the government. That all comes at a cost. So the net result is we have higher long-term interest rates, and that directly impacts our long-term interest rates. So the RBNZ can only they adjust the overnight rate. That flows through to the 90-day rate and then to the sort of 1 and 2 year swap rates. But the RBNZ doesn't really affect much beyond the sort of 2 to 5 year mark. The 10-year mark is almost entirely driven by what global bonds are doing, and you can see that correlation there, where the black line there. Ours is almost at its back at its peak, and that's a reflection of obviously the cost of what New Zealand's going to have to pay in terms of borrowing all this money to carry on spending. The government's running a deficit, tax takers down. They're going to have to issue more debt to carry on. And at the same time, we're in recession, so New Zealand's credit rating is probably at risk here, and the markets are reflecting that. So this flows through to long-term swap rates. And Suresh, if you want to jump to the next slide, you can see here all of our swap rates. It's a bit of a messy chart, but essentially our swap rates are back towards the highs that we've seen through this cycle. And we're a bit dubious about how long or skeptical how long they'll remain at these levels, because that recessionary impact is going to flow through into lower interest rates as the RBNZ starts to lean towards the cutting cycle. Obviously, we're in recession already. Inflation's uncomfortably high, but at some point, the RBNZ will pivot to a cutting cycle. The market will front run that, so interest rates will start to fall before that happens. We just need to see that conversation turn, and then interest rates will certainly come back from their highs. But essentially, that's why we've seen interest rates remain elevated despite the RBNZ telling us that it's pretty much finished hiking at 550. It's just now a case of how long does it stay at 550, what's happening in the global economy, and then when do we see that conversation turn to a cutting cycle?
Ross, I have a question on that one. And back in
Yes, please.
2013, there seemed to be a fair bit of front running as the
Mm.
rates went up.
Yes.
And then it bunches all up as they came down.
Yes.
And they get out ahead again as sort of level bit at 2017 and then start bunching up again as we go down at 2019, getting out ahead again 2021. But right up at the end here, we're all muddled up. And so are you suggesting that they are front running a downward slope at this
Yes,
point?
absolutely.
Or
And
is it going to expand out again like
Yes.
it was in 2013?
But
Yeah.
and I think the key thing too, just is that I think we have to be at a peak. I just cannot see a 6% cash rate, which would take mortgage rates into the 8% level, right? And the last time we were 8% was like 2006, and house prices are dramatically different. And the chart we showed earlier with the bank debt mix, in the banking sector, nearly 2/3 of all their lending is to the housing market. So this is, really reflects that I think we are at the peak. The Reserve Bank is saying that, although there's a couple of banks saying just one little bit more just to put the nail in. But it's really hard to see rates going higher, and that's why it's all muddled up. Everybody's just trying to work out, when do we come down? And that's why, as you mentioned, it is pretty messy chart in there as the market goes from day to day, week to week, working out when the end's coming.
Yeah, and what we're seeing here is inversion. And if you cast your mind back to that neutral interest rate chart that Suresh showed, the RBNZ expects neutral to be somewhere between 2 and 375. There you go. So all of those interest rates now are well above that. And what the market's saying is that the long-term interest rates are lower than the shorter term. So we have inversion. It's an upside down curve, but what the market's saying is that there will be, over the long term, there will be cuts to get us back to that neutral range. We don't know exactly when or how big those cuts will be. But yeah, you're right. Going back to 2013, the market did front run the hiking cycle. And throughout this cycle, you can see we get to about early part of 2022, around about that neutral point, and that's when things started to invert. That's when the market said, all right, you've done enough, you're getting into restrictive territory, therefore short-term rates might go higher, but the longer-term rates aren't going to go with them the whole way. And the market essentially has been inverted for the better part of 18 months, nearly 2 years, which I think is really a telling signal. The market's been looking beyond this hiking cycle. It's always thought this hiking cycle will be temporary, and it's because we got quite quickly to neutral and then beyond neutral now.
Okay.
Cool. Right. Just to finish then, we're almost near the end. Just here's the swap grid. This is where I suppose, we try to manage Western Bay's interest rate risk. And as Ross sort of said, we're inverted. There's actually a 1% fall between the 1 year and the 10 year. And the curve has been artificially held up higher, but as you mentioned, with US treasuries and long-term treasury yields being held up, US and New Zealand. And one point that Ross didn't mention, or I should say, is we are worried about our government's borrowing program. We are borrowing and will have to borrow a lot more money. And that's probably just gone up in the last week because of the way that revenues, export revenues, tax revenues are now under pressure. So having interest rates at these lofty levels is not helping anyone at the moment. And from a hedging perspective, doesn't really offer any value whatsoever. We think this is the worst of it. Just can't see rates being higher. A 1 year swap there, 2 year swap, 582 and 550. Can't see that with a 6 handle. If we do, then we're in big trouble. So in a nutshell, that's a lay of the land. I think we're at the top. We're just waiting for the capitulation.
Right, thank you, Suresh. Ross, we have one question.
Just wondering if you could comment on just sort of things that have happened in the last couple of weeks. You sort of mentioned one of them is the from a government point of view, the significant hole that is appearing in the budget stuff, and that there's going to be the books open in September where the true nature of that will be shown. So that's one point. And the second one was there was $500 million transferred from the Treasury to the Reserve Bank. I'm not a financial person, but be interesting to know what's that signalling, or what the potential impact of that is.
Ross, the second one is they were just putting more capital into the bank, right? And
Yeah, look, I'll be honest. I've got a 4-week-old baby at home, and my second day back at work, so I'm entirely followed everything. But I suspect that $500 million payment will be to do with the bond purchases, the LSAP, the large scale asset purchases, essentially QE. When COVID hit, the RBNZ pumped, correct me if I'm wrong, Suresh, $100 billion into the bond market by purchasing bonds to really suppress the interest rates. And then obviously as they've hiked, they're holding on to these bonds, with 0 and 1% interest rates on them. But now though they're trading in the market at 4s and 5s and 6s even. So they're sitting on a big loss. And the irony is that the RBNZ trying to suppress borrowing rates, but all they do is end up with this huge loss. And I think it's up to $12 billion, the mark-to-market loss. And as these bonds mature, they get obviously less money back, and they're not earning the interest that they could on them. But I suspect the Treasury were funding that position, because at the end of the day, the RBNZ, if they make a loss, they're just going to go to the Treasury to get money to pay for it. They can't create the money to pay for it. It has to come somewhere. So in suppressing those rates, all they've done is transferred that the rise in interest rates to the taxpayer.
And they don't when they buy the bonds in the market, the Reserve Bank, they don't sell them back to the market. They just, mature and expire. And then there's an internal transaction with the debt management office, because then the government has to borrow more money. But yeah, it will be supporting the Reserve Bank's balance sheet.
So I'm a relatively simple sort of person, and what I heard was pretty much a lot of gobbledygook that said that the government has screwed us.
I think it's probably more the RBNZ that did the screwing.
Yeah.
Another question from.
I think just on that, we think that's bad, but that was all a result of quantitative easing, as you probably heard for years and years, and the Europeans and the Americans did a massive amount of it.
Yeah.
And if we think our position is ugly, theirs is incredibly bad. But basically every central bank around the world was doing quantitative easing, which was buying back their own paper. So yeah.
If you do, you can read it any way you want, but you reflect, we're a small exporting nation, meat, dairy, bit of logs, bit of fruit, and, to have engaged in, I think, that sort of practice. We'd never done it before. Our only mechanism in the past was interest rates. And we seem to have, we overcooked it going to 0. Let's not forget he wanted to take us to -50. It would have made things worse. But yeah, there was just a whole lot of things I think the New Zealand and the RBNZ meddled in that I don't think New Zealand really needed to in hindsight. But
And you look at the result, the housing market going up 30% was the result of all that money being thrown at it.
it wasn't productive.
Yeah.
One more, Councillor Revenge.
This is, it's too political, I suspect, but the Chinese market is the housing, they've got a problem. But how much influence has America had on their China's productive sector by the sanctions they've put on them? Because they've been really quite serious.
Quite significant, very significant, because, you know, China's biggest export market, I think, was the US, you know, all the stuff they make, Apple, tech, all that sort of thing. But I don't want to delve too much into the whole political landscape of what's happening there, but there is what they call a chip war going on. There is a war over technology, artificial intelligence, and the US are trying to strangle the Chinese in that sector. And these sanctions are really starting to hurt. And, it's reflective in China's economic performance, which is dwindling. And I've seen some charts which we don't have here, but what the US imports from China has dropped dramatically. Equally, what they exported to China has dropped. So it's quite significant. And then hopefully where you were trying to think is or look is China is still one of our largest customers. So yeah, it's got flow-on effects for us.
Right, thank you. That seems to be all the questions. We'll let you get on with your day. Thank you very much for your presentation. And
Thank you.
You're on.
we'll catch you next time round.
Great.
Thank
Thanks, Cyrus.
Thank you. Have a good day.
All right, so we need a mover and a seconder that the Chief Financial Officer's report. Dated 15th of August 2023, titled Bancorp Treasury Update and Presentation being received. Thank you, Councillor Joyce, Councillor Crawford. All those in favour? Right. You're under.
Good staff. I mean, we've seen the swap rate curve looking ugly. Have we seen any impact on our borrowing costs yet?
Through the chair, I'll let our CFO answer that.
Yes, so we have done some modelling and effectively we've decided not to lock in the hedging because of approximately 160 to 180 would have been the cost if we'd gone down that part. And so we're just monitoring it basically on a weekly basis and carrying on that analysis.
So we're banking on, as the experts say, that this is a turning point.
Yes, absolutely. Yeah.
Hope so.
So I think that does come out in the paper further on, right? I do think we do need to note that that we had those little infringements of our policy that we decided to not correct, and the saving was $180,000. So that was good work by the staff, and we congratulate them on that for keeping an eye on that. And yes, so all right, now we have Leon here from the Auditor General's office. He's our auditor this time round, and we've got two items that he needs to be with us for. So we're going to call for a change of order of business. So to move page 110 up to follow on this now. Thanks, Councillor Murray Benj. Do I have a seconder? Thank you. Deputy Mayor, all those in favour? Aye. Against? Carried. So over to you, Sarah.
Thanks, Murray. Good morning. I just wanted to introduce Leon, who's our audit director, and he's here to take some questions at the end. But before he does, I'll just go through quickly with the paper that's in front of you and a little bit of an explanation on each of them. So obviously, as you're aware, the audit plan is what really sets out the standards of what's going to be audited in this financial year. It's pretty straightforward and I won't go into the details. Obviously, we've got Leon for questions. Effectively, really key points that's going to be looked at is the revaluations of assets, major capital expenditure, impacts on recent weather events, which obviously is quite a big one for us, Three Waters reform, and also the last two on there, the service performance reporting, that's quite new, and there is a little bit of a paper later on. And finally, the overrides, which is something that gets audited every year. Now, one area that we just wanted to highlight is there is a bit of a valuation. As you know, we experienced this during the valuations of our assets earlier this year in the rating area, but there is a resourcing issue in the value across the nation for valuers. So that is a risk that we're monitoring, and we have highlighted that to Leon and team, and we're working through that plan on what that might mean to us. So that's probably just one aspect of our audit of the annual report in terms of the risk areas. The other two are obviously audit fees and the audit engagement letter in front of you. And Dale might want to comment a little bit more before we hand over to Leon on that. So I'll leave it to Dale.
Thank you, and through the chair. So we have been advised early from Audit New Zealand that we were to expect an increase in our level of fees. In the paper, it does outline some of the reasons why they've increased some of their resourcing to the team. As we know, general matters across the board have become more complex. There's more things for audit to be involved with and be across. But one of the expectations on both sides is that we work efficiently through our processes together. And I have to say, with Leon and the team, they've been extremely proactive this coming year, and they only obviously bill on the fees that they actually need. So yeah, we're working as a team moving forward, and very pleased with the conversations, given all the risks that we do face at the moment and the complexities of where we're at. But I will hand over for Leon for any further comment. Thank you.
Thank you. Thanks, Adele. Thanks, Azura. Thank you, Mr. Chair and councillors. Yeah, I think everything I was going to say has already been said, so I'm not going to repeat it and waste your time, rather take questions. You know, just touching on a few things, the revaluations is obviously there's quite a number of judgment and assumptions involved in revaluations, and it forms quite a big portion of your balance sheet. So it's obviously something we need to look at. The fact that it's been delayed, we are working closely with management to see how we can get a work around it, because we still want to sign this or complete our audit for you to adopt your annual report on 26 October. So that's definitely still on the cards, and we're working towards that. The new adopt PBE FRS 48 service performance reporting accounting standard, we're working with management to ensure that there are no concerns there. The good thing is we had it run with the tertiaries already. We know what to expect, what changes should be made. That'll also impact on your LTP, but we'll work closely with management again. And then, of course, recent weather events where you had to make some hard decisions on. We had these projects, but we had a few floods in Waihee Beach and some other bridges falling over. So we know about that, and just keeping a watching eye on that. What's the impact on your assets, as well as possible impact on service delivery, which we don't expect. Now, we perform a risk-based audit, so that's why we've got these areas that we specifically focus on. We also use materiality, which is explained on pages 20 to 22 of your paper. But if there's anything else you think we should need to focus on, or if you want to discuss any of these items, please let me know. The audit fees is obviously the contentious issue, and thank you, Adele, for those comments, because that's exactly what I was going to say. I remember I've been with Audit New Zealand now 15 years, the last 4 in Tauranga, and I remember about 10 years ago, you get a report from the valuer, you say, oh, thank you, 10 million sorted. These days, we have to interrogate those reports, and well, for the last probably 6 years, it's become, auditing has become much more complex, and so we need to have the right level of staff, not only the right number of staff. So we've increased our staff over the last year through COVID, and last year, if you remember last year, we were sitting here, I was sitting next door trying to sign the annual report, and it was a nightmare. I'm not going there again. But to enable us to do that, we need to have the right number of hours, and audit fees are based on hours. And then, of course, not too many people want to be an auditor anymore. My daughter is case in point. I invited her to join Audit New Zealand. She said, nah, I like the BAS consulting, but it's a bit less risky and I get paid more. So we have to increase fees, salaries as well, which obviously impact charge out rates, which impact audit fees. We managed to keep to phase in after negotiation with management, to phase in the increase in audit fees over 3 years instead of upping it to a full extent. Now, audit fees across local authorities this year will increase between 30 and more than 100%. We managed to keep yours for the first year, 40%, and then 13%, to try and phase in those audit fees.
Leon, there's been a fair bit of press coverage on audit fees recently, and it's been discussed at the highest levels in Parliament, I understand. Is there likely to be any change, or what has been set out as what has been set out?
I presume you're talking about the standard of auditing?
No, the fees specifically.
Oh, no.
The increases.
No, increases are going to stay. We know, there was it at the LGNZ conference, a remit? And there was discussions around, the standards of auditing. Are we auditing to too high a standard? But this Auditor General, and I presume next ones will be the same. You have to apply international auditing standards and then convert them to make sure they apply to public sector in New Zealand. No, I don't think there will be changes.
Mr. Mayor.
Thank you, Mr. Chairman. I just want to ask you, Leon, to what extent are the increases in audit fees related to an increase in the depth or quality of the audit needed, and how much is just a catch up from not charging enough in the past? Can you talk to that?
Yes, thank you, Bishop. That's a good point, because we didn't charge enough in the past. We were going to increase audit fees for local authorities in 2020, but then of course we had COVID, and we decided at that stage we're not going to increase audit fees. I think it would be a bad idea. So at that stage already, audit fees were too low across all local authorities. And then, of course, you've got 3 more years that it was kept too low. So good point. I had to catch up.
Councillor Beach.
Just confirming, so you said with the increases, you've been able to get the staff you require and you'll be able to meet the deadline at the end of October.
Absolutely, ma'am. Yeah.
And you had a problem last year?
We did. We did last year, because last year, if you remember, for the previous 2 years, there were the extension of the statutory deadline to the end of December. We worked until, I think you were the last council. No, not I think I know. You were the last council I signed last year, which was horrible. I mean, we were all in Christmas mode and we were sitting here trying to get across the line. But for this year, definitely. And even with the slippage on the valuation side, we're going to work around that. So that when we get 26 October in my diary, that's the day you will adopt your annual report.
Hi, Leon.
Stephen.
Hi. These are caps, aren't they? As opposed to they're not set fixed fees. They're a cap. They're a fee cap.
Yeah.
So in a sense, if through the year or if through the audit process, certain efficiencies come through because we've got continuity of audit team, and there's less reinventing of the knowledge wheel, so to speak. So this is worst case cap pricing.
So if I may answer you on that one. So the only reason I would ask for more money, well, that's the one side of the point, is if delivery is not at the right level at the right time. We haven't seen that from Western Bay. So that's the one side of the coin. The other side of the coin, if I make a profit, if we come in under budget, unfortunately, I can't keep it and buy another house. I have to give it back to you. So you're quite right.
So, right.
If all things are equal, this is the worst case.
Okay. And this is a more broader question. With the emphasis of the audit, and I think the materiality of asset revaluations being one of them, and I guess this is also going to be taking in the Three Waters in terms of considering, its impact, especially I think in terms of not only the annual results, but also to where we go next in terms of the LTP planning. It seems that we've not been in a high inflation environment since the late 80s, early 90s, where it's really made an impact to a lot of these decisions. And it would seem to me that asset revaluations is a question of, wow, it's a question of timing. I mean, what we hear from a valuer today is going to be in this very volatile setting, especially with Three Waters. It seems like it's kind of, where the heck do you pin the tail on the donkey? So how does that kind of come through from your perspective in terms of a big overview for Audit New Zealand?
Yeah.
In relation to, what is it that asset revaluation is actually doing in that kind of volatility? The materiality of change, timing differences, because it just seems to me that it's going to be, and we've just heard from Bancorp, in terms of the housing market. And I mean, if we've got values changing significantly, and as we speak, they're changing, how does that kind of flow through for you guys in terms of pinning that tail on the donkey? Because it seems to me that it's a really, really hard, volatile range to get your head around.
Oh, it definitely is. And, it's not only nationwide, because region-wide, it changes as well. If you look at the different soil conditions across the country, and I'm not even an engineer, and I know about these things, heard about them. But you're quite right. So what we're doing is at the national level, we are looking at, we are acquiring data from all audit teams to get a more relevant view, or a reasonable view across all asset classes, the different asset classes. And then we say, okay, how can we apply that? Now, Taupō's got very interesting rock formations and water drain easier than other areas. So you have to then apply that knowledge to whichever specific region or area or district you're looking at. I mean, just look at the Aoraki Plains. It's so different from what we've got here. So all of that is what we compile a data set centrally, and then we apply it, bring it down to each specific area, each specific asset class. As far as the Three Waters reform is concerned, of course, there are so many uncertainties, because there are so many political movements as well, possible political movements as well with that. So what we do with the audit fees at the moment, we set them as is. If things change, we need to change audit fees, because then, of course, for the annual audit, you won't have to do revaluations for the Three Waters, basically.
Oh, certainly.
Whichever portions of water. As far as the LTP is concerned, when we talk about the LTP fee for next year, we'll bring that in and see how's that going to impact on the fee. I'm looking at an early LTP. Well, your neighbor has to go early because the commissioner is resigning. So we're looking at their fees at the moment, and there seems to be an increase as well, just to avoid surprise in the future. But then, as far as the LTP is concerned, what the Act also says is once you move your assets, your Three Waters assets out of the council to whatever entity there will be, an LTP amendment won't be required. Yeah. The LTP amendment also costs money. Now, I've said a lot of things now. Did I answer your questions?
So what I got from that, which I think is right, is that you're going to look more at precedent as it goes with, because I mean, you're auditing the whole country.
Yeah.
And we might benefit from the knowledge that your team who works on Tauranga, because they're going to be a little ahead of us. So we should be getting all the benefit of that knowledge. So there's no reinvention of the wheel.
Oh, absolutely.
Fantastic.
Oh, yeah.
No, thanks, Leon. That was my main point.
Thank you, Councillor Hawkins.
Yeah, it's this might be a bit of a fuzzy question because it's fuzzy in my mind, but it's along that the asset revaluation. Just whether it's on the balance sheet or whatever the impact to us is with the this inflationary pressures that are happening, that the effect on the value of our assets, that sort of a realistic asset life depreciation replacement stuff. This just tweaked from a anecdotal information I heard in regard to another council that is in has a significant problem because either their assets weren't valued correctly or the asset life is having it's put a big hole in their balance sheet. Just wondering where our council sits on that.
Oh, absolutely. And Azura and Adele actually mentioned it earlier, is how often we talk and make sure that we're on the same page. So it's critical that you know the condition of your assets. That's only part through valuations, but also your asset engineers and your asset management plans, which you're going to look at in detail during your next LTP audit, definitely. But the revaluation itself, I'm not sure which council you referred to, it's probably better not to talk about which one specifically, but there are councils that have significant issues because they didn't know the condition of their assets. They didn't have a full systems that controls your asset register, talking to your FMIS system. And there are gaps, and that means not all assets get revalued, or certain assets get revalued twice, or certain assets fell off the books in 1976 or something I saw last year. Things like that will happen. I won't say it won't happen here because it's happening across the country as all councils improve the knowledge of their assets, which is a good thing, but unfortunately it leads to some issues. It doesn't lead to audit qualifications, but it leads to an impact on your balance sheet and on your possibly on your income statement, depending on the size of your revaluation reserve. You're not an accountant, so I'm boring you with talking about this, but yeah, so we're working very closely with management to ensure we're on top of it. And quite a few of your asset classes were revalued last year. So that gives us quite a bit of comfort that in a year, yeah, there were significant movements, as these guys also said earlier. But, you know, we can work around that because we've got a data set, and your valuers have got data sets across the country as well, which they're now slowly but surely making available to us as well.
Adele.
Through the chair, I just wanted to also comment because I think what Andy was alluding to was sort of the implications of the revals. So yes, we are hearing, particularly this year and in the Three Waters area, that there is some sizable movements that are coming through in revals. We are undertaking both the transport and our Three Waters revaluations this year. And so the implications for us is that we, with the values that go up, then we put the depreciation aside, which then is a cost or a charge in terms of rates. And so there's flow-on effects from revaluations, but it comes down to Leon's point. We have to truly understand our assets and their lives and be able to adjust accordingly.
Thank you. Councillor Coxon.
Yeah. Two really quick questions, and the answer to one of them is probably quite self-evident, but so the first question is, why is there a shortage of valuers and where do you source them from? And my second question is, Audit New Zealand is a government department? No, because you're talking about it like it's your business, so I'm a little bit confused. Is it a competitive market, the audit business of local government?
So, thank you, ma'am. First question, valuers, they are registered valuers. Not quite independent from us, quite independent from council as well. I think the shortage they have is exactly what we experience, and what, you know, there are not enough bus drivers in New Zealand. So it's, for me, it's just what happened during COVID, where people just couldn't get into the country where we needed them. And then once the borders open, and we experienced it the same thing, is, oh, great, now we're going to get some people from, well, I can tell you there are very few auditors left in South Africa because they're mostly here now, but from across the world. Unfortunately, the young Kiwis sat here waiting. They want to go on the OE. The borders are open and they buggered off. So it was a bit of a, so as far as your question about the values are concerned, I think they're just experiencing the same thing as across all sectors. Your second, Audit New Zealand, we're not a government department. We're independent from government and the parliament, which is critical to ensure our independence. You know, if we want to make comments, Audit New Zealand is a business arm, as they call it, of the Auditor General's office, which is completely independent. And, you know, if we want to make comments about either the government or local authorities or public sector across the country, we need to be completely independent. So we're seen as an officer of parliament, but definitely not as part of the government or government departments.
So it's not a competitive market where there's others.
Oh,
yeah.
No, I think if I was in private sector before, so no, it's not a competitive market as you see it. The way, for instance, fees are set. So first of all, the Auditor General uses quite a few audit service providers, of which Audit New Zealand is one. In the local authority sector, they also use Deloitte's, and up north was EY. EY, yeah. So they are, and KPMG, I think. So there are a few others that they use as well. When they set the audit fees, they look at the fees of all these, what they call audit service providers, and compare, for instance, Tauranga City Council with Hamilton City Council, by Western Bay of Plenty, etc., etc., so that they get a view across the country that all fees are reasonable for the size of the entity.
Okay, so we have a recommendation that the finance manager's report on audit plan, audit fees and engagement for the year be received. Have a mover and seconder for that, please. Mayor and Councillor Murray-Bench, thank you. All those in favour? Against, carried. All right, now we're going to leap ahead to page 110, 10.6. Well, we have Leon here. And
Thank you, Mr. Chair.
And back to Azura.
I see.
Leon, we'll deal with it. The letter of representation. That's your one as well.
The debenture trustee.
Oh, my apologies. That one.
So page 110, 10.6.
So yeah, you've got in front of you the letter of representations for the debenture trust audit. Obviously, this is the second part that comes through after the annual report is audited. As you've got there, effectively, this is just the separate letter in terms of the audit for that. If you've got any questions, happy to answer. And we've got Leon here as well. Thank you.
All very straightforward. Any deep and meaningful questions? No? All right. So
I was trying to find my notes. Sorry, Murray. Will that audit also test reported covenants in relation to the debenture trustee?
Yes.
Yeah. And how they're calculated?
Yeah.
Great. And in Appendix C, I'm just wondering, will you, when you're looking at security stock, does that include security stock issued to banks for derivatives and for facilities like the Westpac facility, and that's an issuance of security stock as opposed to your LGFA type of stock. So will it also?
No, those covenants will cover under the annual audit.
Okay.
For this one, it's an assurance. Oh, my apologies. For this one, it's an assurance engagement. So it's a higher level of assurance.
Right.
It is not that lower level of assurance for external audit, like we do for the annual audit.
Okay. But I guess it was more my question when one's understanding the amount of security stock that's been issued, reconciling that. It's going to be, it's going to include not just LGFA, it's going to be including the bank facility, the security stock on issue in relation to other areas.
Just trying to think, as far as I can remember, we're specifically looking at your debenture trust deed.
Yeah.
So, Stuart, you've got me there.
Oh, that's
not 100%.
It was just if not, it would be great if it is part, if it could be part of it. So we see the full story and the reconciliation of that. That'd be great.
That we do as part of the annual audit, because it's important to the annual audit and the financial statements more than this debenture trust deed, which is just at so much higher level.
Okay.
So just if I may, so in terms of the annual report process, those all get audited. This particular one is just in terms of the debenture trust deed, which is held with the trustees. So it is only specific to that.
Yeah. Okay. It's the same information, but that's okay.
Yeah.
That was my.
Okay, excellent. All right. So we have a recommendation that the finance manager's report dated 15th of August, letter of representation debenture trustee audit be received. Thank you. Deputy Mayor, Councillor Murray Benj, all those in favour? Aye. Aye. Against? Carried. Right, Leon, we'll let you go.
Thank you very
much for coming
Apologies for earlier.
and answering all the questions. And I think it's a good time to take a break for morning tea. So we'll be back here at 10 past. Radio team, let's. The recording has started, so. Okay, so we're on 10.2, back on page 53. And we'll hand it over to Clint.
Thank you very much. Good morning, all. So just a quick overview on the health and safety report that you've all got in front of you. For the quarter, really continued positive signs for our teams. No significant events occurred through the period, and we are progressing the implementation of our strategy, which is fairly well outlined in this particular report. We did continue with focus on those already identified risk points, the aggressive behaviour that our teams face out in the community, and then internally our staff wellbeing too has been a really big focus for us. And so there's a whole heap of the graphs and reporting and stats through there that we can touch on if you'd like, but otherwise I'll open it up for questions. The strategic piece has been the really big piece of work for us that we're really looking to drive our behaviours.
So, Andy.
Oh, morning, Clint. Just you note lag indicators, but sort of nothing referencing lead indicator type stuff. In that space, reporting of the near miss and those things that nothing actually happened, but it could have, and that requires quite a good level of culture to feel safe to actually report stuff that makes people look bad. Would you be able to give a view on where our organisation sits in regard to that sort of someone being willing to put up their hand for something that was they did dumb or?
Yes, yeah, no problem. So the lead indicator piece is really important for us. So we've in the process of developing what those lead indicators look like and putting some communications out to our teams. Near misses is absolutely one. Contractor works review, safety engagements, site inspections, vehicle inspections, all these types of things are on the agenda to roll out to the teams. One of the other things that's mentioned in the report here is the psychosocial risk of the mental health stuff. So we're just mindful of the change management piece on that. We have to do that in a structured and planned manner so that we don't overload people, because we do want to get that buy-in. But creating that safe space and getting people to report stuff, even if it didn't happen, is absolutely one of the key things that we're focusing on. Once we roll that out, that will come into this report as well.
Just to follow on that, so once you start nailing that sort of stuff, the level of reporting goes up.
Correct.
Just from a councillor point of view, noting that that's actually a good thing.
Absolutely. I've referenced it a couple of these meetings ago as well, that we anticipate reporting incident reports to increase once we do start to drive that behaviour, because I certainly believe that we will get more. The more we encourage people to create that safe environment to report things, that we will just start to hear about more things, which is positive. It's not always a negative when you start hearing incidents.
Go over here, Councillor Crawford.
Yeah, I was just thinking about that mental health side. So I was just thinking about like our librarians, people like that that stuff that they get from the public, and that I was just interested about, I suppose you'd be aware of that, what we're seeing that play out like even in our town. So
yep, absolutely. That's one of our critical risks to our teams is the public interaction pieces, and particularly those community centres. There's a whole range of changes that we're making around the key factors, I suppose, around process and how we deliver the services that we do, the relationships we hold with some of our stakeholders in the communities, but also internally, the training we're providing our people, and then the technology that we can lean on as well to provide some support to those teams. The current process, understanding psychosocial risk and trying to manage those is getting information from our teams to understand what their safety is in their work environments. And then we've engaged an external provider. So once we hear the reports and recommendations from that, then we'll be able to work with our leadership to try and drive some of those changes to improve that.
Thank you, Councillor Cox.
Probably more a question for John or you, Rachel. Just under psychological risk management, talks about delivery of bullying in the workplace content. Just a little bit more detail on that, if you wouldn't mind.
I don't actually quite understand the question.
It just says there's some content being delivered, just wondering what the process is around it. I presume it's internal and external bullying as well, so could have apply to things like in, the library situation, but also internally?
I think if we're talking about the psychosocial training that we're doing, yes, it would apply to internal. So it's actually more internal, the work we're doing on that program. It's actually about what is anything that happens in the work. We're really good at understanding our physical risks, but what are our mental health risks? So it would include bullying, but it also looks at harassment. It also looks at things like workloads. Just anything really that is impacting negatively on someone's mental health. So the work that we're doing at the moment is to more deeply understand what those things are for people. It's very hard to generally know what they are and what's going on with people, and it's not necessarily things that do happen within the workplace. It can be things that other stresses that people are going through as well, that they obviously bring to the workplace and take home from the workplace. So a lot of work to really understand that through focus groups, through surveys, and then once we understand those a little bit better, we can create an action plan or some strategies to help mitigate those risks.
If I can quickly just elaborate on that too, around the bullying content. So through Pink Shirt Day, we had a whole information content piece that we put out to our organisation to introduce bullying, to try and identify some messaging from our key leaders about what that looks like and the support the council provides. So that was where the content delivered around the bullying harassment came in through the quarter.
And I think, and just to put your minds at rest, I'm not aware of any particular issues that we have in that space. Darren would be closer to it. I'm not suggesting for any second that we have got that we're worried about our culture from that perspective at all.
Councillor Murray Bench.
Yes, could I just follow on with that public confrontation? I noticed that's quite significant. What section of our staff, in what section are they getting most of this public confrontation? And do you know why?
So some of it's in the community library space and those service centres for a range of different reasons. And so there's not one particular reason. And also in our compliance teams, particularly animal services guys, when they're out there dealing with the animals in the communities, they have to bring an animal in, that's someone's loved one, and so we get confrontation with certain members of our community. But this is where some of those process and some of those relationships are trying to support that.
Is the animal the dogs?
Generally dogs, yes. But they're generally not the problem. That's the easy bit. Yeah.
Councillor Crawford.
Yeah, I was just the other question I had was around about the in health and safety. It seems to be sometimes people are afraid to report, whatever reason, especially if there's bullying or something like that, but also about consequences. So how are you finding managing, that health and safety remains as actually a positive thing that is like a heavy hand?
Yeah, look, we always continue to promote really positive culture, engaging culture. We promote high trust all the time. We can't fix the secret. So it was all about the relationship and our approach with our team members when it comes to ensuring that we're creating the right environment where people feel safe on a lot of these matters, whether they're risk-based, safety-based, bullying and harassment. One of the key things that we do take very seriously is creating that environment where people are who do feel safe to come forward and report. And like I say, we can't fix the secret. So it's really important that we continue to promote trust in the workplace. And I'd just like to condone Clint since he's been here. It's very much been a key focus of his approach in terms of building those critical relationships with our team members. And I can look back and say that he's got excellent relationships and I see that working really, really well. So I'm pleased from that perspective.
I just noticed, can you just confirm, hopefully I haven't missed anything, but contractor mental health or public confrontation, is that something that they report to council or is it just something they handle themselves?
We have a bit of both of that. Some of our contractors will just handle that themselves. I literally just had one this morning where one of our contractors was verbally abused by a member of the public. And so I've asked that comes into our system. That will continue with the contractor engagement and behaviours that we're looking to build with our contractors to establish what those reporting cultures look like. So the short answer is they will deal with those themselves for the most part, I would suggest, but we're looking to bring that in-house so we have more visibility of it.
Yeah, because obviously contractors are working for us. So some people see a contractor as a council worker sort of thing, don't they?
Yep, absolutely. So yeah, the one this morning we put that in our system so we get more visibility of what that looks like.
All right, excellent. Thank you.
I was just going to add to that, Councillor Kelly, you probably appreciate that while they are a contractor, we're still accountable for the health and safety aspect of that legislatively. Because they are a contractor, that doesn't provide any exemption for us in terms of our accountabilities under the Health and Safety Act.
Okay, so we have a recommendation on page 53 that the Health and Safety Wellbeing Leads report dated 15th of August, titled Health and Safety Report, be received. Move in a second. Thank you, Councillor Crawford. Mayor Denia, all those in favour? Right, against, carried. Thank you. On to page 60 and risk and assurance. Ernest.
Morning, Mr. Chair and everyone. This is the risk insurance update. We're covering 3 areas, which is the strategic risk, the internal audit plan, and the affordable waters reform. The strategic register, we haven't had any changes since the last meeting we've had on the 9 strategic risks. And we're planning to actually carry out an SLT risk workshop every quarter after this to update the strategic register and also highlight any other strategic risks that we come about. And we've also had captured a range of agreed risk appetites. So if you see page 66 of the report, it highlights our risk appetite, and it's low, medium, or high. And we've got operational risks, health and safety, well-being, growth and financial sustainability, and community sentiment as a low risk appetite. Medium, climate change, significant external events, people and capability and capacity, and high risk appetite in central government reforms in partnership with EB and Maori stakeholders. That's where our risk appetite sits. So that's the update there. I'd like to allude us to the roadmap, take us to the roadmap where we are at with things. On page 64, please. We started our journey first introducing the risk management framework. We brought the framework to council and SLT had a risk workshop there. We confirmed the risk management framework. And then we assessed the residual risk ratings against revised risk appetite. We then reviewed the top risk categories, which is the 9 strategic risks. Where we're at now is to communicate the changes and implications across the organization. And then we are going to identify adjustments to risk mitigation activities to close gaps. And then we are going to conduct a training. We blocked out a training to introduce the risk management framework across the business and also introduce the risk module. We have a risk module in ProMap. ProMap captures a lot of our business processes. So the risk module will be linked into this business processes where we can capture risk live as they actually populate their business processes. So that's where we're heading. So we have tentatively booked the month of September to carry this out. Moving forward. So that's the risk activities that we have in place at the moment. And emerging risks, we've captured a few new emerging risks there. Inflation. Well, inflation has an impact on existing and future contracts, as we can see. Interest rates has an impact on borrowing costs. Insurance with an increased volatility market, as we mentioned here, through weather events has and the climate change has increased our insurance costs. And as you heard a big Bangkok's presentation today, our insurance costs certainly will increase. Affordability is another emerging risk that we've captured, and the capital expenditure delivery, CapEx and delivery, as an emerging risk. So those are the new emerging risks that we've captured. The internal audit plan has highlighted 3 audits. We have the financial contributions input setting and billing audit that we've completed. Fraud gap analysis review that was carried out by Deloitte. That's going to be presented in the confidential risk and assurance report. GST and FBT tax compliance evaluation. The audit is completed, but we are awaiting management comments to come back to finalize that report, those 2 reports. And finally, the affordable reforms water report at the bottom. So I'll take any questions.
Councillor Wickers.
Yeah, thanks for that. I'm glad you referred back to the presentation earlier on. So as councillors, we've been getting a consistent message now, meeting after meeting, that costs in every area are increasing significantly. It's probably not a question, but probably looking to the rest of us as we go into this LTP, we're really going to have, if we thought that the 7.04% discussion was hard, what's coming our way is even harder. And really understanding priorities and what we let through the gate and what gets the gate closed on it.
Quite so. On page 78, Ernest, in the last box in your little table there, it says due to staggered start dates, there may be opportunities within other entities for staff to transition to. My understanding of the legislation that was put through was that any of the 3 water staff were guaranteed their current jobs in their current locations at current salaries and terms and conditions sort of thing. So how does that play into that with possibly people moving out?
I'll talk to that through the chair. So what we're saying is with the different dates of starting, yes, there'll be some job guarantees, but there may be some unfilled positions as well as they go into those new entities. So it will give others the opportunity to apply for those roles should they become available. But there is a job guarantee for those staff that we do have at the moment, where their role is a certain percentage of their time. And then there's 3 categories. There's sort of up to the 30%, 30 to 70%, or those greater than 70% with the job guarantee. So each are kind of working through those processes.
So these are effectively people who would step outside of that guarantee and say, well, I'm not going to stay here, I'm off to Wellington or Christchurch.
So through the chair, so for an example, you may consider corporate services too. So you might have a certain percentage of a person's time is undertaking the 3 waters activity, but that will create a job at the other end. And so for most councils, 3 waters is only a component of the role. So therefore there will be opportunities happening.
I think I'll just add to that. I think certain staff weren't guaranteed roles, senior roles. So some of our managers haven't been guaranteed a job. So for instance, if Waikato went before us, they might look over the fence, over the hills, and see that opportunity while it exists. I think the other risk that we have in this space is just natural attrition. So, we get natural attrition, turnover of staff in any field. I think attracting and replacing those people as they leave when we're in such an uncertain time about what might happen will be very difficult. So I think those are the two risks.
Yeah, it's a kind of similar point. I think there have been moves where I've been trying to get some sort of certainty on when we transition. I know there's a lot of political uncertainty in that, but I think just waiting for it to be done to us by government is a dangerous position for us to be in, and we're trying to get some sort of certainty on that, but it's proving difficult. Yeah.
Any other questions for Ernest? Benson.
Hi, thank you. It was really good. I really enjoy the work that you folk are doing and would really compliment you in terms of what I see around the traps. And I'd certainly find this really, really useful going forward, maybe in time for the next committee meeting, but it would be really neat to see a very summary assessment, qualitative assessment on what management think will be the main impacts each of the risks has on your LTP assumptions. And as it's more of in order to give councillors a bit of a heads up, especially on the concerns that we will have in relation to cost increases, where they're going to be, what that's going to do. And it would be really good to see that. I use the word roadmap because it is but it's a qualitative roadmap, and it's not a biggie. It's not it's a one pager, but it's kind of sets a scene so that when council do really start to get into the nitty gritty of the LTP assumptions, they sort of get a background to why they are and what those material changes are likely to be. But this has been really good, and I really appreciate the fact that you've identified as an emerging risk rather than lump it into the risk 6 growth and financial sustainability, that you've put the inflation and interest and other things in as an emerging risk, because I think that's really quite transparent. And so no, I just say compliments.
Right, thank you. So we have a recommendation that the risk and insurance report be received. Thank you, Councillor Joyce. Councillor Coxhead, all those in favour? Against, carried. Page 81 for accounting policies. Leave zero where she is.
Thank you. So I just want to talk to this paper on accounting policies. Obviously, we just touched on this earlier on in terms of the key areas of audit focus, and as part of that, we mentioned a couple of these ones. So there really is three key areas that we're looking at in terms of the accounting policy review. The first one being obviously in terms of the service performance, which we talked to earlier on. There's been some changes in terms of what it looks like in our financials. They're all mainly around the qualitative, so we're working through with audit on those and what that will look like. It's not going to be very easy to describe in this forum, but it's obviously technical, and we're working through. We at the moment we feel that we're on progress and in agreement with audit, so that's going very well. The second item on there is around the financial instruments. Again, there's some classification changes that we're working through. Again, quite a technical one, where we've worked quite closely with them again, and we seem to be on track on that as well. In terms of what that looks like, we'll obviously bring that through in the draft financials as we present. Just a heads up again in terms of the financial reports that will be scheduled a little bit later today, and in relation to the policies, they are drafts as at May, and I just want to highlight that because of the changes that we're working through, which will come again, but quite a theme on today's paper. So And those are the really three key areas, and the policies as such are mainly the same other than those three areas, and open to any questions. Thank you.
Councillor Coxhead.
Sorry, just on the changes in measurement for the financial instruments, could you just give an explanation for dummies on what just high level what that is?
Yeah, sure. I'll try to give a quick explanation. So in terms of the explanations, it's really in terms of the changes related to the disclosure. And so the financial assets, there's two key areas: the financial assets in terms of how we fair value measure. Effectively, IFRS 7 talks to the disclosure of fair values, and most of them are through the comprehensive income. So statement of comprehensive income, how it actually gets disclosed, and then some of that sits on the equity statements. So the materiality of it is probably in terms of where it's sitting, if I can just simplify it. So some of them in comprehensive income, you'll see those areas listed. And then when you go to the balance sheet, you'll see them relisted in different areas. So in terms of the instruments, they do go through the comprehensive income statement and then go to the balance sheet. So the difference in the notes, I don't have the note in front of me, but when you compare that to, say, 2 years ago, what we listed, the notes will look a little bit different. I'm not sure if that fully.
So you're talking about the bonds? Is that what you're talking about? Bonds?
Not just the bonds, so all fair value measurements. So that will be fair valuations of all securities listed. So cash flow statements. What else is a good example? Mainly bonds, yeah, mainly bonds. Here. So.
Medina.
Through Mr. Chair, I just note on page 83, the Three Water Reform Programme still refers to 4 entities. Is that going to be updated?
83, yeah, yes, yeah. I think that's a screenshot from one of the previous, yeah.
Okay, thank you.
Councillor Daly.
Azura, just on the link that you've got in the report to the actual IFRS exposure draft, there's a comment there that there's a possibility that loans where the interest rate depends on the borrower achieving environmental targets, is that something that's listed as a key area of interest for New Zealand? Is that something that we're required to comply with, or has there been any indication that we'll have to meet certain environmental targets too?
I can speak to that one through the chair. So we currently borrow through the local government funding agencies. They are now creating what they're calling sustainable loans, which do have a different criteria set against them, which does reduce the cost of borrowing if you meet that program. I don't know all the details, but that's certainly something that we'll look at moving forward, because they're just new to the market effectively. So thank you.
Okay, all right. So the recommendation on page 81, that the review of accounting policies and key accounting judgments be received. I'll move that. Thank you, Councillor Murray-Benge. All those in favour? Against, carried.
Oh, sorry, thank you.
On to page 92 and financial performance update.
Thank you. So just following on from the theme, again, just to highlight, these are May accounts and not June accounts. We're working through it. The team are busy working through the revaluations at the moment, being the key, and we hope to table a draft set of accounts for June year end. Effectively, just key highlight areas. As at May, we are effectively 90% to target in terms of the budget to actual revenue, which is pretty much in track with our draft accounts at this stage. In terms of the expenses, also around 91%, which is quite on track as well. The key thing just to highlight again in terms of Treasury is that we are in breach of two of the brackets. And again, earlier this morning, you heard the presentation from Bancorp on as to why we are, and it is a management area that we are continuing to monitor. And we are quite comfortable with where that is, and it's prudent decision in terms of savings and not entering into it too early in the process. So at the moment, rough estimates were 180 at the time of reporting, 180,000 savings as a result of not locking in those breaches. So just wanted to highlight that we're aware of it and we're monitoring that. Those are effectively the key updates in terms of the report. The dashboard does provide the highlights in terms of where we're heading. Again, all in par other than those. I'm happy to take any questions. Thank you.
Councillor Joyce.
I noticed you've got a surplus, stable surplus to date of 14.6 million, being 800K ahead of year-to-date budget. I realise end-of-year adjustments can play havoc with such numbers, but we're required to budget for neither a surplus nor a deficit. So how does that work? Because that's quite a long way from balance. That's one question. I've got another one after that.
Yeah, sure. So in terms of the balanced budget, we can balance a surplus, and the idea is that there are elements that get removed from the balanced budget calculation. And so when we present the annual report, you'll see those movements, and we're presenting those. There are a lot of year-end adjustments that go through. So they are effectively the accruals. Obviously, the likes of revaluations get removed from those adjustments. And so hence, these are just management reports at this stage.
Hang on, Rodney.
Through the chair. I just wanted to point out that, obviously the timing of when projects or things happen during the year is not an exact science too. So when we're rating for activities, any residual funds go back into the current account of that activity anyway, and we can draw on it again in future years. So so some of what we're doing, if it's a contract and it's running between years, then we'll carry that money forward and for it to be used for the purpose in which we rated for it in the first place anyway. So I think just knowing that it isn't an exact science, and we do keep a focus, particularly in challenging environments like we are in at the moment, where costs are higher than potentially what we rated for. So we have to then moderate as we're going through the year. Thanks.
Another one is obviously we're continuing to be challenged in how much of our CapEx we get done, right? So we're currently at 60% for the year, going into the final month. Again, I take your point about some contracts are paid at different times, but it does seem that we're having trouble delivering the level of work that we've committed to our ratepayers to do. And at what point do we sort of have to start scaling back our CapEx because of our capacity? Because it's not the first year or the second year even that we've had this kind of issue.
So through the chair, so the couple of points on that one, I can let you know that we did complete the year at 77% of completed capital program. So still short, yes, but we do also acknowledge that there were a lot of weather events during the year that had an impact on the focus of the team, because they had to refocus on priority projects in terms of the community, but then also noting that in even our risk profile around the ability to get contractors on board, etc. I agree with you, though, Councillor Joyce, that there is an opportunity to review the program as we move into the long-term plan. But obviously, the last couple of years have been, quite tight. But Audit do focus as well on our deliverability of our long-term plan and what we're doing to put in what we have in place to demonstrate that we can achieve it.
Sorry, can I get one more and then pass it on? Was it pushing it too hard? A number of times we've asked for more regular current account and internal loan balance data. In the last triennium, I gather these were provided quarterly, and I think I showed you a report that was done in March 22. We've been told that we have to wait until the audited accounts are done. And I'm not quite sure why, and I presume council staff are tracking these balances more regularly than once a year, because otherwise, it'd be a heck of a mess trying to tidy them up at the end of the year. So what can we do, please, to get more regular feeds, as used to be provided, on current account and internal loan balances, as per the last training?
Through the chair, I'll start to talk to it, and Azura may like to add further information. What was being provided for on a quarterly basis was an estimate and a forecast, and it wasn't actually a transaction through the account. Currently, the processes are for the funding to be undertaken at the year end as a complete picture. So yes, it is a challenging process to get through the funding allocations. We are very much focused on moving forward and improving our systems and processes. It's really important to me and Azura. And so we're implementing tools and processes that will get us better in this space as we move forward. So yes, we'd like to be looking to meet your objectives as well as our own. Thank you.
Thanks. I think Adele covered that up. I just want to mention one more thing, that we are looking at future forecasting more regularly as well, and looking to do a rolling forecast going forward and working with our suppliers. And so we're hoping that this will address some of those treasury as well as the current account, and looking at the holistic and feed into some of the LTP conversations going forward as well.
Denia. A couple of questions. Firstly, following on from Councillor Joyce's question, the lack of delivery of CapEx seems to be a systemic issue amongst all councils. I think most councils manage 70 to 80%. So 77% we're probably doing okay. But my question there is whether, because of that systemic issue, if we decide to do, even if we pared back the program of what we want to do, is it likely you'll still only be able to do 80% of what you try to do because things go wrong, consents don't come on time, whatever it might be? So is it a question of trying to do too much, or is it just the fact that you can't do 100% of what you want to do because stuff happens?
Through the chair, often it can be a hybrid of everything, and so sometimes it is about timing. What we're trying to do, for example, as we're moving through the long-term plan, is really clearly identify where in the process or the project management framework each of our projects are. So we don't want to go, right, we're going to deliver a new pool next year when we haven't even designed it, for example. So we will, it's about the programming, the timing, the work involved, and making sure that we are being realistic in that whole program. Obviously, the actual spend in a year sometimes can be, can move and fluctuate depending on what can be delivered as well. So it's never one thing, but we're trying to look at what we can do to deliver to a program. What you have enabled here as this council is the ability to bring things forward which could be delivered and which may replace something that can't be delivered in a year as well. So that gives you, when we're talking about the deliverability of your program for the year, that's one other thing you've got at your toolbox and that is implemented to deliver.
Thank you. My other question, completely different topic. On weighted average cost of funds, I said it's currently 5.37%. And if we take as a read or that's correct, we heard this morning that we're at peak interest rates, will the average cost of capital still keep increasing as old debt matures and new debt is taken on? And if so, what is that likely to max out at, given our debt profile going forward?
It's a really valid question, and it is really hard in this inflationary times to actually lock that down or answer it very specifically at this point. However, we've done some really high level modelling, and as Vancorp indicated this morning as well, they are predicting that it's going to be going down, and we will be looking at perhaps the last quarter at this stage is when we're thinking to lock down, just as an estimate. And so at that point, we're hoping to be able to bring back some information at that point. And so we do feel that it's right at the peak at the moment. if that gives any assurance, but at the moment it is really a hard one to give a number. However, we, based on our modeling and, just to give you that assurity, we are going in very low. And so the 5 million we've just locked in literally yesterday, we're taking it as required basis, and that's our mitigation strategy at the moment.
Thank you.
Councillor Lally.
Yeah, I just want to clarify Adele's, your answer to James and Rodney, and looking at your analysis in the paper, it appears that physical project delivery is not really an issue. It's really about planning, designing, consenting that's causing the lack of meeting the target. And I guess you answered that with staff resource being the issue, of contractor resource. But I mean, when you think about capital expenditure, non-performance or non-delivery, you automatically think work on the ground. Or so it's interesting that I don't know what percentage would it be, probably 80 to 90% is actually non-physical works.
Through the chair, probably not quite that high, but I mean, there is obviously a mixture, and some of our capital spend could even be a land purchase, which it's all about timing as well. Yeah, so there's a lot coming into what then gets capitalised or deemed to be the final asset. But you're right, there are certain components that do take longer than others to get in processes to get through, including consents.
And I guess is it fair to say that we're under-resourced because we haven't been able to recruit the right people, or is it just do we need more people, or the people that we've currently got are just stretched with the workload? Or
I think these are great questions, and probably need Gary for some of this. And we could maybe address some of this at the next projects monitoring meeting. What I'd say, Grant, is if you're going to ask staff whether they need more people, probably know what answer you're going to get. I think what we're currently missing is a maturity of reporting, which I know we're working on, where we can actually see in the development life cycle, from inception to planning to project management through to actually doing the works, to see where each of the budgets is at and each of the projects is at, and that will also help us to, I think that's cut out, has it? Yeah, it's gone. That'll help us to understand whether we've got any roadblocks. So where are we actually stuck? Well, no, I think it's Greer turning me off. Yeah, so it'll help us to understand in that pipeline where we actually might be getting stuck and what is actually taking the longer period of time, so that we can address some of those issues.
I think it's timely because this will be quite significant for our long-term plan, like Rodney suggested, that this is an area of real, and Andy, in terms of, trying to keep our rates increased next year within, I mean, it's something I've always said, and the answer in the past has been, and I probably haven't seen a detailed breakdown like that in the past in terms of project delivery. I always thought it was just physical works was the problem, and that, with fine weather you can catch up. But I think we've got to the point where we've got a reset point, and that will definitely help us with our LTP next year.
Yeah, and the other complexity in that is, of course, the projects don't start on the 1st of June and finish on the 30th of 1st of July and 30th of June. Some of the budgets that you see, or capital expenditure that you'll see coming through in FY23, is actually from budgets from FY22. So there's it's a constant movement of those projects. So we need to understand where each project is and what phase and how it's affecting our projects.
Did you have a question?
Through the chair. I've got a few questions, if it's all right. But I'll go to the one that's been brought up, and hopefully I might be able to pull it a little bit together. If you go to page 102, and there's a really nice chart there, capital expenditure, and shows actual versus budget. And so I'm curious is that, and this is great to see, except that if you look at that came off. Yeah, sorry, I did have it on and just seemed to have disappeared. Sorry about that. But if you look at that chart on page 102, capital expenditure 2023, we've got a $5 million variance right at starting point, which is kind of odd because ordinarily you'd expect that you've got it right, that you've got your forecast right, and that you'd probably have the first couple of months kicking off pretty close to forecast. And this is really showing we're kicking off already 5 million but behind. And I'm wondering in terms of the information and in your response, Adele, and around the reporting as well, in terms of how good we can get that reset figure when they're at the very beginning of the budgeting process. And is that what's the biggest issue there? I mean, why was there, for example, a 5 million immediate starting point of variance?
Through the chair. So ultimately it's about timing. When we're looking at the budget, our budgets are normally prepared pre-Christmas, and then we're out for consultation the following year for an implementation date 1 July. So, that time frame is very hard to judge. And then in terms of where we're at in the current year, then exacerbates it. So there is an opportunity to obviously look at how we do some of those processes moving forward. And we've now got a principal advisor project management who's helping us with some tools and systems at the moment about how we get smarter in that space. But as I talked about too, it's about delivering to that total value. So understanding where our projects are, to how we might manage in the course of a year to manage to the budgets in terms of delivery.
Okay, that kind of takes me to a curious question of mine, which was when I very began looking at the summary on page 1, on page 93, where we were seeing the variances there. I mean, we're looking at actual versus budget full year, but in the document there's a lot of reference to revised budget, and I found it really hard to reconcile the variance numbers. I mean, these numbers here, they're not 90% or 91. I mean, you're 99% based on these numbers. Then you go into the document and we see revised. So I got a bit confused, I must say, in terms of understanding variances and what are we dealing with, and what's the difference between revised budget and budget. I'm sorry if it's a really dumb question.
Through the chair, and no, absolutely a great question. So for the way that we do the financial management here is revised budget includes the carry forward from the prior year, which speaks to some of that timing issue in terms of delivery.
Okay. Yes.
And without the ability to be able to change, it's what we've brought forward into the current year. So then we start to look at then forecasting for that year about what we're actually going to deliver.
Thanks.
It could be operating or capital, but tends to be the capital space that we do revised budgets for.
Okay. To the just if I might, with another question, Chair. In terms of the go forward and what's the plan, and from what I got today from Bancorp, it seems that what they're saying is, look, we think that a reasonable rate is going to be at the starting point is at the top end of the Reserve Bank's normal or neutral, and that's 3.75. Our cost of funds is about 85 basis points, so 3.75 plus our cost of funds is kind of where I think they're saying is the top end of the band that they are suggesting to you, that's where you would begin to implement policy. And at the moment we're not, because we're outside of policy, which is a bit difficult. What's the plan? Are they saying, hey folks, leave orders with the banks for swaps at 3.75 and better in order to reach X percent of requirements? Or is it, I'm sorry to say, I don't know what the strategy is.
Through the chair, and as we're probably step in as well, but we have to be quite clear about the assumptions that we use in our long-term plan. And so we have to work with our advisors and what they're going to be and how we are going to do our financial management for the long-term plan. This is, one of the most challenging environments to be in, to crystal ball all of this. But I'm just thinking, do you have anything further to add to that?
I think that's a good summary, Adele. Look, we are monitoring it quite closely, as I've said, and it is a matter of, if you lock it in too early and then you get stuck, to unwind it and the cost of breakouts and all of that. So we are looking at it. In terms of a strategy, we're obviously in that long-term planning phase at the moment, and so we're hoping that a couple of workshops into the long-term plan decisions in terms of the capital program, that really those early modelling will help us give a better outcome. And so one of the things that we are measuring it against is forward forecasting as well as balancing it, and it's a tricky one. And I guess we don't want to lock it in too early and then regret it. And we went back and remodeled some of those and said, how do we feel right now? And that was that discussion around, we would have made a loss of 180 at this point if we'd locked it in 2 quarters earlier. So we're happy to keep reporting that sort of modelling and provide that assurance if that would help. But obviously we're definitely not sitting back and just crossing our fingers. We are modelling that quite regularly and keeping an eye on
that. Do you mind? Maybe if I take you to another chart so that I can express myself with a visual. Often find this a bit easier. Page 108. These are great pictures to have because they give us a visual of where we sit with 2 different scenarios. I think it's the way to see it. This is what our interest rate position is currently, and we see on the right-hand side what that might look like. Correct me if I'm wrong, post 3 orders. But I know the variability or the problem that you're expressing that you have, which is, hey, we don't know what our debt forecast is going to be. And so how do we know what we're going to hedge and what those policy parameters are going to feed off? But there are a number of scenarios out there. We know what they are. We've got a 3-water scenario. We've got a non-3-water scenario. We've got a adjusted or an adjusted budget scenario based on what we now know in relation to the here and now with CapEx and CapEx spend. It seems to me we're flying really, really close to the wire on all of them, not to be in a position of having some kind of strategy. If we do see rates, within the next year fall to across the curve to below 3.75%, is there a plan? Because otherwise we probably need to know how ugly it might look. Because at the moment your floating rate cost of borrowing is essentially at the 90-day bank bill rate. That's 5.8%. And then you add your margin to that. That's a here and now, it's a given. 10-year is 4.8. And as we've heard from Bancorp today, they think that's too high, and their rationale around that, which is saying, well, you don't want to really go out and lock in 10-year money at 4.8. And the yield curve sits in between, okay, at the moment. Not at levels that anybody's comfortable with based on the presentation. You've got, as we know, long-term rates in the US up over 4%. And we've got the Fed that's still keeping interest rates high, and we've got our own Reserve Bank that is maintaining high for long in order to nip inflation in the bud. And we heard from Bancorp today that they don't expect much to change there for the next 6 to 12 months. That 6 to 12 months is already on us. So it's real, and it is the counterfactual of all your planning. And as much as I know that we don't want to go in and lock in 10-year money at 4.8%, would you be wanting to lock in some 4, 5, 6-year money at, from what Bancorp is saying, 3.75 and lower? I guess it's a case of, forward planning, acting on a plan, because at the moment it's sort of, I'm sorry, it just seems a little bit, we're looking in the rear vision mirror, and that's what a policy's for. I mean, the policy's there for a very, very good reason, and it's been developed. I don't know who did it for you, but it's the policy is developed to safeguard the intergenerational cost of funding that council commits to over a long, long period of time, to give you certainty of an understanding of what it is that you've got to play with. I'm just a bit uncomfortable without seeing a strategy, plan B.
Thank you. I think you definitely raised some valid points. Obviously, it is hard times in terms of predicting the future at this stage, and we're not the only council going through this. And definitely in terms of the monitoring strategy that we do have in place, we definitely do have a strategy. So just to, obviously the strategy is not to what we're going to lock in at this point in time. The strategy is actually monitored on a weekly basis and keep on top of it. The other side of it is we're actually actively investing in whatever we draw down and the cash flow. So that is being monitored on a daily basis. I just want to highlight page 109, if I may, please, so that just to give you that reassurance on terms of how we're monitoring the daily basis cash flow funds. And that graph there shows the cumulative interest income earned, which you can see there starting in July and to date June 2023 as at this day. So this particular one is the June result as of now. And what you see there is that in terms of the strategy, just keep on top of the interest rate movements, the flip side of the revenue, how we're managing that. And so while that is not locking in today for a whole heap of years forward, what we're doing is managing that and mitigating it until such time we're comfortable to lock that in for the future. So that is being maintained, and the rates that we're getting on that is quite good. So you can see there that's offsetting. And so this is obviously the other side of what we're doing in terms of mitigating that strategy. And we're hoping that we'll be in a position to lock something in, and we're happy to review if you'd like to look at something else and relook at that. But however, the indications and the calculations that we've backtracked on indicate that not moving at this point was in our favour, and we'll continue to assess and monitor that and report on that as well. And happy to take a different approach if the committee wishes to discuss.
Move to Dale before.
Through the chair, in terms of our total debt and forthcoming changes and around our strategy, just want to note that approximately $87 million, which has been agreed with DIA, is our Three Waters related debt. That we're still working with them in terms of what that timing might be and how long it will be for them to repay that. That has to fall into our strategic thinking as well as we're working through the long-term plan. Certainly take on board your comments, Stuart, in terms of what that looks like and the policy changes we do tend to put through a long-term plan process, and this may need to be something that we then bring to the table again for further discussion alongside with how that would be strategically implemented given the volatility of the market. But certainly we lean heavily on our Bancorp, who are our advisors, to help us through these processes. And in the last 6 months, we've had someone who's almost half of their role is dedicated to treasury management, which we didn't have before. So just giving all that information as well. Thanks.
Deputy Mayor Scrooge.
Yes, so just following up really from Stuart's questions and Azura's response there in terms of weekly monitoring of interest rates in the situation. My question was going to be, at what point would you consider locking in funds? But then I've heard Adele's comments and about the reminding us of the consideration you have to take into how long that funding might be needed for. But so that was really my question. At what point would you consider locking in funds again?
Bancorp's obviously monitoring that and giving us advice on a weekly basis. On top of that, we're looking at, as soon as we know in terms of the current position of capital expenditure, and depending on what's required for the future. So we're sort of at a high level monitoring our internal procurement plans and things like that. And as soon as we know there's something big that we're going to lock in, that would be the point that would trigger us. So, you know, say there's 40 million coming through and we're now locking that in the procurement plan early in advance, that will be a trigger for us. So internally, we're liaising with our GMs and all of our project managers to ensure that those information is being fed and captured, and those discussions are being had quite actively internally.
Councillor Coxhead.
One really quick, easy question, and one actually for Stuart. So there's no RWT deducted from interest earned for councils, is that correct? Interest income? Resident withholding tax? Is it zero rated?
Can't remember off the top of my head, to be honest. I don't think there is. I don't think there is.
So that's a gross. That
should be the gross, yeah.
Yeah, and I appreciate it's there offsetting cost as well, but of course, inflation at 7%, take RWT off that. You don't know what rate it is? RWT rate? 39? No, it's tax.
You've got an offset in relation to anything that you earn in interest is directly offsettable to what you pay in interest. So you don't have to worry about it's not public where we've got term deposits and we're suddenly losing what our the tax we're having to pay on that. You guys don't pay tax.
So you're saying it's zero rated RWT? Yeah, thank you. That's answer. That's what I thought. Okay, so Stuart.
No, questions have to be to Azura.
Sorry, Azura. All right. So what is Stuart saying? Is he saying that we should have a strategy where So is Stuart saying we should have a strategy or be considering a strategy where we're perhaps spreading our risk in terms of swaps? So looking at a tiered swap, let's say 5 tranches or whatever. Is that what he's saying?
I don't know that it's very fair to ask Zero what Stuart's saying. Take that on over lunch.
Through the chair, may I answer that? No, I'm saying is there a strategy that can be considered by council that is going to say, this is what we aim to do, i.e. there is a rate, yes. If we saw those rates or we saw the yield curve fall to a level, is there a rate that Bancorp would give us advice on a forward basis to say, we would be looking at implementing a strategy to increase the hedging of, and that's all I've asked is there a strategy there?
Yes, that was Adele's answer. That is something we'll be dealing with in the long-term plan process.
And that's in process.
Yeah. And in the meantime,
through to you, Chair,
they've got their eagle eyes on it, watching it carefully and saving us 180,000 at the moment and what have you. Yes.
through you, Chair, and just want to point out 108, their strategy is there as well in terms of what their thoughts are at this point in time. So obviously we're monitoring it, LTP, in addition to that, they are looking at that as well.
Yeah, and that was a strategy to deal with the breach. And mine was just more broader as of what's our plan B, yes, and what's our ongoing strategy, because it's we've got all this planning to do, and it'd be good to know what they're saying.
Yes.
Whoops. Yep. Okay. I guess we've had a lot of discussion about the apprehensions and concerns about this report, but I just want to say that I think in general it's a good report, and particularly in terms of around operational income and expenditure. It's pretty close to budget, and with 11 months of the year gone, I think we should be very grateful for that, particularly in light of some of the other very gloomy news we've had this morning.
Thank you. Did you want to second that?
Can I speak to it as well? I mean, I'm also very pleased with the tight interest, and bad turn of phrase, that the staff take in managing our risks in this regard. I picked up something from Stuart, maybe I heard you wrong, but I'm certainly interested in some idea of scenarios. Everybody's saying interest rates have peaked, but nobody knows how quickly they'll fall. I looked up a couple of numbers here. US inflation down to 3% sounds good, but core inflation, which takes out energy and some of the more volatile elements, is 4.8. So that's the number that central banks tend to look at, and that's a lot more stubborn. New Zealand inflation, heading down, great, but core inflation, according to the economists' estimates, is still up around 7.1. Now, core inflation doesn't affect so much ordinary people because we'll enjoy the benefits of lower energy costs, although if you've been past the petrol station today, you'll notice they seem to be evaporating. And it takes out fresh fruit and vegetables, which of course is a major cause of pain for householders. But it is a number that, because those are so volatile, central banks tend to look at. With core inflation at 7.1%, I don't think we can look at interest rates falling very fast. And certainly from Stuart's point, scenario modeling, what does it look like if they stay high? And what does it look like if they drop? Certainly the yield curve seems to suggest that people aren't expecting it to drop very fast. But the yield curves can be funny things, right? Because if they're inverted, they're also predicting a recession. So we've got a lot of work to do. I'm particularly thankful for Adele's comment that work's being done on more timely reporting. I'd love to get a time frame of when that kind of, I realize the body of work you've got to be doing, but when that will actually start flowing through to us as more information would be quite helpful at some stage. But I appreciate, this sounds a lot of pointy-headed stuff, but it does have a real impact on ratepayers. And the better we do with this, the more freedom we have to do real things. So it is really important. So thanks, everyone.
Right, thank you. So, Councillor Murray-Beach.
I'd just like to speak to it as well. I think, sir, our staff are working under extraordinarily difficult exercises at the moment, and we're lucky to have got as far as we have, as well as we have. While the government continues to spend mightily, the Reserve Bank's got no alternative but to keep holding on to interest rates because it's the only real lever it's got. And it should be a combination between government and Reserve Bank, but at this stage, it doesn't seem to be. The dilemma for us is Three Waters, and because if Three Waters goes through, then this council is in a very difficult position, and our future, I think, would be really quite tenuous. And so if the opposition do win and we go back to as usual, then I think what we've got before us today covers us in that regard. And I just think we can only go by the information that we've got available to us. And I'm ever so grateful that we've got an independent member of this committee as well. It's a great help. So I just want to say thank you for the work that's been done and wish everybody well and hold on to your seats in the meantime.
Right, so the recommendation on page 9. Sorry? Any other speakers? No. Recommendation has been put by Deputy Mayor and seconded by Rodney. All those in favour? Aye. Against? Carried. Where are we up to? Information for receipt on page 125, 10.6. Against. One, two, five. Sorry.
Thank you, Mr. Chair. The Audit and Risk Finance Committee work program focuses on key areas, focuses on governance, diligence, and the term of reference for the Audit and Risk Finance Committee. So there are a few changes that has happened since February 23. The first one being the change for the review of accounting policies and a key accounting judgment from May 23 to August, which is we just heard. The Audit New Zealand audit plan, an engagement letter moved from May to August. We also heard that recently. And the credit rating review has moved from August to November 23. So we've removed the CE only time from the work program.
So the motion's been put. Any questions before we ask for a seconder from Ernest? No, well, I shall second the motion. All those in favour? Against? Carried. Right. Lunch first. Oh, that's true.
And you got that 1 o'clock, and Alan and whoever else is still online?
Call them in.
We're not getting staff back in here for litigation to talk about the details, so.
For
the litigation.
Oh, no.
What's a responsibility is what basically need.
He's refreshed, ready for action.
Okay, so we have a resolution to exclude the public and move into confidential. Thank you, councillor Joyce, councillor Murray Benj, all those in favour? Right, against, carried.